I think when we get the data this Thursday, you'll see another decline in real estate values um, on household balance sheets. So we're already starting to see a softening on the real estate side. I've been on record saying that I think there has to be a 15 to 25% correction in residential real estate values over time. This is a slow moving asset that adjusts very glacially. So, it's a multi-year process. But the bottom line is the combination of a correction, a material correction, obviously 20, 30% type of correction in equities, and the continued slow decline in real estate values, I think raises the probability that by the end of this year, we could be in a recession. So there are things that have to happen, obviously, because we're on equities, we're only down 5%, which is nothing. And on real estate, it's a glacial process. So there are things that do have to take place, but I think you have to start thinking about how markets and asset deflation can create a recession, because it's very different than the typical thinking that it has to come from higher unemployment or the Fed raising rates. I think this time around, it's going to be a deflation and a deleveraging and an unwinding of asset values, such as we're seeing already in private equity. That will create the recession in the future, not higher unemployment. That will come after the fact, or not higher rates. So that's my thesis, and I'm sticking with it.
Hey, Charlie, that wealth effect from real estate and stocks, what percentage of that is concentrated in the wealthiest? In other words, that wealth effect is accrued to 15% of the population because that's who owns stocks and valuable real
Yeah,
estate. And so that was my first question. How concentrated is that wealth effect?
yeah. The Z1 doesn't break it down by income cohorts, so I don't have an answer to that. It just shows a consolidated number. But I think it's something like 20% of the population is accounting for 80%. It's that 80-20 rule, 80% of the spending now.
Right.
So it's that upper income that is going to feel the negative wealth effect if we have a correction in stocks and equities. And so that's what I'm watching is does that upper income, and so you're going to want to listen to what Ralph Lauren has to say, what Tapestry has to say, what Viking Cruise has to say, Ferragamo, all those high end consumers. And I think Berna has pointed out that in the first quarter or year end calls so far it's been pretty good. But on the housing front, Toll Brothers has started, their upper end housing, they have started to see the same margin pressure that the low end guys have seen. So there's starting to see some resistance. It just depends on what consumer product area you're looking at.
Yeah, I guess when I think about it, that 20% where the wealth effect is concentrated, the biggest risk to the market is that they've been holding stocks. In other words, I haven't been selling. For me, I'm not selling stocks. I've just spent based on what I think my income is. But if I think all of a sudden my wealth is going to drop sharply, that's where consumers come in and panic and say, "Well, I'm up 50% on stock XYZ, so now it's down 10%. I'm not going to write it all the way back down." And then that sort of feeds the momentum on the downside. If there is some event, some panic about a pullback in asset values of the stock market, I think that's what creates some of that fear and the downward momentum that you talk about. But for a recession, then I guess that high end has to say at some point, well, not only am I worried about my wealth going down, what I see on paper in my portfolio, but now I got to spend less because I don't feel as wealthy. Not that I was counting on selling stocks to be able to spend for my vacation. It's now you feel like your income or cash flow is at risk to the point where you slow down your spending, I guess. And
Yeah,
when does
the
that
Fed is
that pullback, that feeling of my wealth is going, convert to okay, now I got to be more frugal in what I spend.
Yeah, that there are some studies done by the Fed that show that the wealth effect is overtaken disposable income as the primary influencer of consumer spending. Um,
Interesting.
so yeah, I do think, and the other thing is, we have this buy the dip mentality has worked beautifully for the last 5 6 years. Um, if you look at the Mag 7 stocks, it's not working anymore, the buy the dip. And you have to sort of wear those buyers down before you get that kind of correction that doesn't bounce back. And that's important. I mean, if we get the COVID type reaction where you get a 30% sell off and then we quickly come back by the end of the year, then the high end's not going to feel that negative wealth effect. And you have to wear down those buy the dip buyers first and have that correction stay down and just move sideways, where it's just tough to recoup your gains. I mean, recoup your losses. And I think that's the kind of market that, we risk going into 27 is that we get a correction, whether it's this spring or next fall, I don't know. I've been talking about a big correction, by April, May, June, where the Dow, I mean, the S&P is down 6,000 or so. I mean, to 6,000. But, I think there has to be a lack of a bounce to really make people feel less wealthy. So we'll see. But, the odds of a recession are climbing. There's no question about it.
Hmm.
So, we call it a morning, Bob, and thanks for joining us on Wall Street Beats. It's March 16th. And if you want to learn more about energy, Bob Morris is our expert. And if you want to learn more about financials, I'm happy to help.